Hi traders, my name is Joseph. So this is my part of the 2023 TradeZone special reports. I'm focusing on oil now, so I'm going to do this video in two parts today, which will obviously be in one video, but there'll be two sections. So the first section, I'm going to discuss trading oil, and I've got my setup in front of me at the moment, so there's nothing really amazing about it. It's just a single moving average and a CCI indicator. So we're going to run through, why I like to trade oil, my thoughts about trading oil, some of the advantages I see with trading oil, and just generally how I look to make positions from the 6-hour chart. And so the second part will be basically more focused on the analysis side of the year that has been so far, and we'll look at next year, and we'll look at some of the factors that be going into the market next year when we're looking at analysis for the year to come in 2023. So we will we'll get going. So if you can see at the moment, I have a 6-hour chart in front of me. So why I choose a 6-hour chart is I find the 6-hour time frame is not too short and not too long. So another decent time frame is the 8-hour, but I do find the 4-hour and the 1-hour a little bit too fast for my liking. So trading is really a personal preference. It's about what you feel comfortable with, and you try to just find all those right ingredients that sort of suit you and your lifestyle as well. So if you have a very busy lifestyle, it's extremely difficult to try and scalp or trade off a 5 or 1 minute chart if you're constantly not able to spend enough time looking at the charts. And also maybe you have a full-time job and you have to go to bed at certain hours, so that can be a big issue for you, as some markets, especially crude, do move a lot harder in the New York session than other periods during the day. So I kind of find the 6-hour time frame is a happy medium for me. It allows me to have enough time to sort of analyze and look at what's going on, and then be able to catch the close of the 6-hour bar. And I only miss really 2 closes, I think, during the day due to bed and other commitments I've got through. I'm very lucky due to my job that I get to watch the markets majority of the day, being an analyst at Eightcap. So that is definitely a helping factor for myself, and it does give me a lot time to be able to watch the markets really until I go to bed, and from early when I start work around 9 in the morning to between 9 and 10 in the morning. So I have a lot of coverage, and with the 6-hour bars, you don't need to be obviously watching it every minute. So I usually trade at the close of each bar, and we'll look for a position at the close of each bar. So sometimes I have 6 hours or 4 hours up my sleeve before I need to make a decision. Now the other aspect of the trading that I find helpful for myself is I try not to take too many market orders. I find that they can push in emotional decisions into your trading. So I like to put in a buy stop or a sell stop above the previous high or low, and look for an entry. Occasionally, at my own discretion, if the signal bar is extremely wide, I may not take that buy or sell stop, and then I will look at going into the market with a market order at a level that I kind of feel is suitable. Because at times, if you wait for a market to race up by 200 to 300 points to fill your order, you've straight away just added 200 to 300 points to your risk management, and sometimes that might not be feasible, or you may have to take a trade that's extremely small, and these are factors you have to really think about when you're trading. So why do I focus on oil? Well, this year oil has been absolutely fantastic. It's had some really extreme influences during the year, and I'm not going to get too much into. Obviously, the Russian invasion of Ukraine is not a positive, but we need to just look at it from a market movement point of view, and that point of view is that we want the market to move. Now, unfortunately, as when you're trading certain markets, that can be good or bad reasons that are moving a market. Obviously, an invasion of a country is a very bad reason, and it has a real human cost, but just putting this into a trading perspective, we just want to see the market move and some strong trends in both directions. So one of the hardest things for myself to deal with is sideways markets that have very little movement, and constantly, because I'm buying high at the top of a high or selling the bottom of a low. If you have a strong sideways market, that can set you up for a fair bit of pain if the trends don't follow through. So we can just see here from this period going back really to July, we can just see a lot of nice runs. There's plenty of points in there. One of the other reasons I really do like oil is you can see even just this point here, just from the top here up to here, it's 249 cents. So there's a lot of room for movement. So you can have situations where you'll take a trade and it may not follow through. And a prime example is this here. We had a buy here and it was triggered, the market ran up, but then it reversed, but it had put on just over 100 cents. So you had time and opportunity to manage your risk and put your stop loss up. So even though the market did reverse, you had time to manage that trade. So, and that's the other beauty of the 6 hours. You have a bit of time to manage your positions and manage your risks. So that's one of the beauties of the oil market at the moment is how much it is moving now. That is obviously a double-edged sword. You can also be caught and hit quite hard. Now, a period that was a little bit tricky, I remember, was back in October. We had this period here, and that wasn't too much fun. And so basically, when I'm looking to trade the market, I'm trying to stay with the trend and I'm trying to follow the trend. So it's nothing, there's nothing really, sorry, my mind blank. There's nothing really game-changing here. It's pretty basic and simple, tried and tested methods. You're just following the trend and looking to move with the money at the moment. So how I do that is I basically look at the slope and the angle of the moving average, and if the last period is pointing up high and then we had a buy here, obviously I'll be looking to buy. And here was flat, so even though it started to curve down in this period, I don't really want to take it because it's not in a downtrend just yet. So you can see here we had a push down, we had that rally up, we had a new move down, and then it fell. So an indicator I use to time this is the CCI, and it's very simple. Again, it's just across the zero. I do like to see them come mainly from the what they call an overbought area or an oversold area, and I do find that if they're inside these two lines, when they give a signal, that signal could be a bit weaker, but it doesn't come into play too often. So mainly what I really want to see is there's some market slope. I'll look to continue in that direction for the next entry point. So you do really want to be careful in flat markets. You want to give the market a bit of time to sort of tell you. Again, this is not an exact science. You still will lose on a certain number of positions, and there is nothing you can do about that. You just have to accept it as part of trading. And sometimes with the nature of oil, especially like we can see yesterday, we had a strong move up, saying that we could see a new move higher. We had a break of the trend. Everything looked pretty good yesterday. We had a continuation. We had a nice break higher, but that failed and we saw a move lower. So I don't try and go into the reasons as to why we saw two bars go down and reverse. I really just sort of accept it and say, okay, that is what the market's telling me. And then what I'll do now is I'll wait to see if we have more moves down, and if we have a rally come up and that goes back up and back down, I'll look to take a position selling the market if everything's met. So that's mainly how I trade the market. Really, any indicator can be used for the timing. You can use an RSI, you could use a stochastic, you can really use anything. You don't even need a CCI either. You could just do it by eye if you are quite comfortable with spotting new retracements and then when they're breaking. So a prime example of what I was talking about earlier about when you're looking to sell or stop, obviously you can see there wasn't much of an entry at this point here. We had that bar down that closed. It's very far away. So if you were looking at this bar here and then you had a new low put in telling you to sell, you may want to just think about that from a point of view in common sense, because that is a very deep bar, and and you're talking about a stop loss straight off the bat of close to 500 cents. So 500 cents in oil is a lot. Regardless of if you're trading a micro, a mini, or a lot, it does add up. And that's one thing with oil you do have to be a little bit careful about. It swings rather hard, and if you don't manage your risk properly, you can be cut up quite badly and suffer some pretty bad drawdowns. So you really have to manage your risk. That's one of the keys of trading oil, and that's why situations like this here, you need to use a bit of common sense and just have a think about it. And maybe it's better to wait for the next retracement, which came here, and then look to enter again. So you want to really just have a good think about your trading, not to try to be too greedy, and you also want to have some discretion in there, and you don't want to be just too rigid and just following everything that presents itself, because if you do that, you can be caught out, and you could end up taking some very heavy losses, which could destroy your entire month. And that's a real horrible feeling when you have some good wins throughout the month, and then you have two bad losses or two bad decisions, and they wipe out all your gains for the months. Now, I know it shouldn't happen, but we don't live in a perfect world, and it does happen, and I think it happens to a lot of people, and you have to try and minimize that, so the work you're doing throughout the month is worthwhile. So that's some of my sorry, I still have a bit of a cold, and doing my best to get over it, so if I do start coughing, please excuse me. So that's some of the again, that's just a bit of talk about how I look at trading the market. Obviously there are many different ways to trade the market, but as I've pointed out with oil, it does swing hard, so I really like to try and get in with the money, try and pick a retracement, and then take a chunk out on the next leg. And but obviously there will be many, there are many people who trade oil primarily and solely, and that have a lot of different ways that they would trade the market. So that's the other beautiful thing about trading. There's no right way or wrong way. It's really the only way that suits yourself, your personality, your personal risk tolerances, and something that you're really comfortable with. So we're just gonna have a bit of a zoom out there. We're going to jump over shortly to the second section of this video, but I just wanted to give you an idea. Even on just looking at the 6 hour, we can just see the movement, the movements we saw this year, including when we had that extreme rally up, up close to 130, and then that decline down after that was sort of all done and dusted. So this is USO USD, which is basically W2I US crude we're looking at throughout this report as well. So that's it for that part of the video. If you have any questions or you'd like to discuss anything more, feel free to contact Eightcap and just attention to Joseph, and I'm more than happy to answer any questions or listen to any feedback you have. That would be fantastic as well. So on to section 2. So we're just going to switch over to the daily chart now. So this is the current daily chart of oil. So we don't need to, I don't think we need to go through too much of this year so far. It was probably one of the busiest years I've seen in oil for a fair while. And if we go back and have a look, we can see, even back from 2020 when COVID got underway and we had that real debacle with price dropping below zero, zero on the futures, and price fell all the way back to that, that astonishing, level. I think it was some futures exchange contracts got down to $5 or something like that, but our low was at 7.27. So it's pretty remarkable that we saw 7.27 turn into 130.23. Really 2 and a bit years later. So it's quite remarkable, isn't it, when we look at that? So this year was mainly the main driver for the first half of the year, obviously, was the invasion of Ukraine and by Russia, and that really had a very strong geopolitical influence on price. Obviously there's other factors this year, including OPEC, and we had some other factors, due to COVID, due to demand, due to other issues with China, their COVID policy, etc. They all played into it. But the real key one, and the one I think we all remember, was the price surges off the war with the invasion of Ukraine by Russia, and that's when we saw that dramatic move all the way up to that 130 area. Now, we do remember there was a pullback, and we had that new push higher, and I think from memory that around that time we did have a pretty interesting occurrence from President Joe Biden, where he basically released US emergency crude into the market to basically stop the rally, because coinciding with all of this, extremely high oil prices, which came basically at the worst possible time, was global inflation, soaring to levels that we hadn't seen for a long time, and interest rates started to rise. And oil basically is needed for production. It's needed for transport. It's needed for growth in economies. Without it, there's some major issues. But if oil is too high, it starts to damage economies. So it's quite interesting that it's not only is it a source of economic growth, but it also can be a source of economic pain if it hits areas that are too high. And those reasons are that it starts to really ramp up production and transport costs. Those costs are then passed on to the consumer. The higher those costs are, potentially the lower the sales will be, and it's just a recurring circle. And we felt this dramatically in Australia. It's being felt dramatically in the US and Europe, New Zealand, and all over the world, I'd say. I'm not sure on gas prices in China at the moment, but I know that our prices have been extremely high. I've heard some insane prices that are in the US. I heard that New Zealand's fuel, petrol and diesel prices were well over $3 before we started to see some really major hikes here. We were seeing well and truly over $2 a litre for fuel here, and that really just does hurt consumers on a basic level. If you were planning a trip away on a budget and you were driving, these type of fast increases in fuel costs make you really start to double think things about whether you're actually going to do that or not. And this was really at the grassroots. And then there were transport companies that were really getting into trouble because of their costs. Their fuel costs were starting to really cut down their profit costs, and this was having a huge impact on their businesses. Fuel costs are still pretty high here. CPI has cooled a touch. It's cooling a touch as well in the States, but we always joke that we've seen a pretty decent drop in oil prices, but we haven't really seen a decent drop in petrol prices. But I think that's a whole nother video, to be honest with you. So at the moment, after we saw, it was around that time, I think from memory, that we did see that emergency crude get released, and then we did see this decline. And at the same period of time, we saw a very strong US dollar. We'll get into some of the OPEC parts of it in a moment, but we're obviously seeing prices continue to decline, and they've been stable, sort of semi-bouncing around this 77 area for a while. Now, Russian sanctions have come into play, but I know there are still some economies that are still purchasing Russian oil, but yeah, definitely those sanctions have come into play. We have heard President Biden say that if oil did start to go pretty crazy again to the upside, that they would potentially release more emergency crude back into the market to stop it. So that was a threat there. Now on the OPEC front, there's been a little bit of not infighting or instability, but there has been discussion and a bit of disagreement on some of the producer prices, and if they were going to bring in a set price. I'll bring that up a little bit more in some of the factors for next year. But again, what also we've been dealing with is economies and demand. That has been a little bit mixed. So a lot of economies have been starting to recover from COVID, and we did see some increases in aspects of the economy, but they've also been hit now by very high CPI, and a lot of that was also fueled by earlier price rises in oil early in the year. So at the moment we are seeing some very strong support down at 76.45, and this is that area that we're looking at here. We do we are hoping this. We are looking to see if that becomes a type of floor. Now, the dollar has been declining recently, and we have seen a pretty sharp move lower yesterday, and we are going to look to continue to see if that demand will continue to feed in from that area down and below, just below that support point we've just put in there. So the market at the moment is still, what would say, we had a fast trend break here, but we've had one leg up that broke it. We had another test that failed and put in some pretty, key resistance, which is sitting up at 93.61, and we've had that decline down. It's nearly a double bottom there, but we had this tail put in a lower low, and we would like to, we're not hoping to see now is there a bit of a range has set up, and if you are a buyer of oil, you'd really be looking at a bull trend to get back underway. You'd be really wanting to see this area hold and buyers come back up and potentially break that range. Now, if we do break that level and we do see a new downtrend come into play, we would like to firstly, if they break this level of support, we want to see if the market can get back down to a level not seen for a little while, which is down around the that 70-point flat area. Now, if this did happen, I think there would be some kick up from OPEC, and the talk of set prices could come back into play. Other factors. So they really can't have oil under a certain price level, otherwise it becomes not unprofitable, but the profitability is very, very low, and it's not in their best interest. So this is the real hard part globally with oil, that there's two key factors and parties that are really at opposite ends with each other, with the producers in the Middle East wanting high prices, and then consumers and governments around the world wanting reasonable prices. So these two factors play off against each other, and the demand factor as well, that's really a bit wishy-washy at the moment, with economies trying to get back on track but not really being back on track yet at certain areas. So job numbers are stronger. I see Australian job numbers were very strong last month. US job numbers are pretty good, and unemployment is very low. But again, if oil prices go back too high, that starts to put pressure back on other aspects of the economy with CPI and inflation. So moving forward onto 2023, just furthering from there, these are the levels we'll be watching through December into January and February, and we want to see if we do get a breakout of either area, but if there's going to be an upside or a downside breakout. So some of the factors that we are looking at is demand and OPEC's supply cuts are a big factor going through. So there is a lower supply with Russia. OPEC has talked about supply cuts, and this did feed in with Joe Biden's comments about if they did cut supply, that could raise prices, put pressure on inflation, and then there was talk about more emergency crew coming back in to stop that, and I think that's really where it did stop. But supply cuts will have to be a factor next year. The market is expected to be a bit tight, and this is basically due to the Russian oil supply, and if OPEC does start talking again about supply cuts, so with a tighter supply, the general consensus is that the market could be higher next year. We could see higher prices in 2023. There could be a couple of factors as well about how strong our economy is coming back. It does CPI come down, and do we start to see a lot more economic growth? And then the other factor as well is we can't discount is China. Now China continuing to move forward with their COVID zero policy. That has started to soften lately. There's been a talk of potential softening in that area. So if China's economy does come out in full swing, and we are seeing production and a lot of areas ramping up in China, there could be more demand for oil, and if the market's tighter, that could definitely help with prices going higher. Another aspect was stat I saw the other day was manufacturing demand in China was took a real big hit I think it was the last month or for this quarter. So is that due to COVID, their COVID policy with factories being closed and put into lockdown? We're not sure. Or could it be that economies are not ordering as much from Chinese producers? That is another factor, and we'll have to see if that does bounce back into 2023, and if that does then put demand higher and with a tight market. Now, some of the other factors just to have a look at is, if obviously with OPEC obviously sticking to supply cuts, the weather is also another big one. Like, what type of winter do we have this year in Europe and the US, and how much demand will that put on oil and gas moving through that winter? And so also, another factor is Iran and Venezuela. Now, Iran's probably a long shot to come back online as a producer. I think Iraq as well is a bit of a long shot. But Venezuela, we do know there's a lot of political issues and instability in Venezuela. But let's just say they did start to come back into the oil market and start to produce. That could increase supply, which could also pick up some of the loss from Russia and could balance things out, and it could reduce some of the tightness from the market. So they are the keys to watch. But from what I've heard, I'm not too sure at the moment whether Iran or Venezuela are close to really getting back online properly with oil supply. Another factor to watch is the EIA, and they see fundamentals allowing increase, but the market is quite doubtful at the moment. So the EIA has been a little bit negative on demand moving into 2023. Another, as we mentioned previously, is OPEC. If they do look to reassert a floor price, and analysts are seen as torn between a cut in production from OPEC, and this is again, I think, due to some of the comments President Biden made that were quite stiff and stern when we did start hearing production cut talk coming out of OPEC this year. So these are definitely some of the factors that could have an influence on the market moving forward into 2023. And the COVID policy in China definitely is one to keep an eye on, but we do really feel that's starting to soften a touch there, and I think they're going to try and roll out of that in a gradual pace. And but again, we'll just have to keep an eye on that, and if China does really come back in. And the other one as well next year is just, we've been hearing a lot about this global recession. The UK is in a recession. We keep hearing about the US potentially going into recession, but does that actually eventuate? And does, there's some pretty stern words out there at the moment about where the world economy is headed. I don't know if any of you listen to Ray Dalio, but there are opinions currently circulating that there could be some big issues, whether we do see that or not. But obviously, if one thing is for sure, if the world did go into a very strong or fast recession, that would definitely have an impact on oil prices, and we would say to the downside. So we'll have to just watch with interest with a few factors moving into 2023, and just see if the market is tight, and if we do see prices recover, or if we do see other influences and worries continue to overlap, and we do see that this current price trend here, if it doesn't turn into a long-term, a bit of a wide range, if we do see a new breakout lower. So we'll be watching these two levels moving forward into 2023 to see if there is a break lower, or if there is a new move back up to test the top of the range and a move higher through the range. So that's my piece for this series. Again, if you have questions, or if you'd like to tell me anything I've missed, please feel free to do so. I'm primarily a technical based analyst, and I look at the market mainly through the price action on the charts. I do get involved fundamentally a little bit, but I prefer to try and not work out too many reasons, because the reasons can be too fast and fluid when you're trading on a 6-hour chart, for instance. So I'd love to hear back from you if you have any comments, and we wish you the best for 2023, and let's hope we all out there get some good trades, and have a very happy 2023 to all. So thanks again for your time. I wish you all the best, and thanks, and bye for now.